Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. And joining me at MarketSite is Phil Davis. He's the CEO of PhilStockWorld.com. And the big story in the market has been the U.S. dollar and trade policies, that America First policy. Phil, as always, thank you for joining me. And let's get right into it. How has the U.S. dollar been impacted with this America First trade policy that we're looking at right now?
Well, you would think that it would strengthen the dollar, but overall our policies have sort of since Trump took office, the dollar's lost about 15% in value, which is scary. You know, in a year to drop 15%. That's the buying power of everything you've saved over your entire life has dropped 15%, including the value of a lot of your assets priced in dollars has gone down. It's not so much the trade policy, which hasn't actually happened yet, other than a couple of tariffs, but what it is the central bank is still on an easing mode. And the very loose tax policy we have now is sort of an overriding impact that's created a vacuum that's weakening the currency with our ability. The strength of your currency is partially like the ability of your government to pay debts.
Right.
By not collecting taxes, we lower our ability to pay debts, making our currency more shaky.
Right. Well, do you think, so could a protectionist stance impact trade? Because the overall theme that I got out of Davos, we'll use that as a barometer from last week, sounded like there was a lot of bullishness coming out of it, whether it was on the global economy or the stock market. So do you think that isolationist policy would impact global equity prices?
Sure. I mean, if you have a trade war, that's bad for everybody, and that's the first barrage being fired is there was originally the 300% supposedly tariff on Bombardier,
right?
But that got struck down in the World Trade Court. They said that's insane. You can't do that. So we got slapped by the WTO saying that can't be done. This washing machine thing, now there's a tax on washing machines and dryers, I guess, and something else I forgot.
Solar.
Solar.
Right.
And that's horrible. The solar panels. First of all, making solar panels is a fairly toxic thing. And it's not something you really want to bring that back to America in the first place. So I don't know why you want to penalize people importing solar panels. The solar panel industry is 50,000, not even, probably 25,000 jobs overseas. The solar installation industry is hundreds of thousands of jobs in the United States that can't be gone overseas because you're installing the panels. Why would you not want to encourage that industry, not discourage it by making the solar panels more expensive?
Right.
That makes no sense. I mean, you have to have a trade policy that makes sense.
I mean, I wonder though if and this also out of Davos, if Trump has dialed back a bit, because even though he said it's America first, it's also not America alone, right? And it sounds like there might have been a little bit of dialing back there, though. But I mean, we're such a global, multilateral society right now. It's hard for me to understand how an isolated America would work.
I think with Trump, you got to kind of focus on what he actually does and what the administration does, because it's the same thing. He goes to Mexico, build the wall, there's murderers, rapists, blah, blah, blah. And then he goes to Mexico, he's like, I love these guys, they're great. It's like, so you can't go by what he says when he's in Davos with all the globalists who believe in free trade. He's in a room full of people. They did boo him in part of his speech, but that
was media related.
Well, yeah. But people booed about that, and so you don't want to have he doesn't want to have a totally hostile audience. These guys are all about free trade. They've been pressing free trade for decades. That's the whole point of this conference, is to encourage free trade. You can't go there and say, I don't believe in free trade, we're pulling out of everything.
Right.
So he had to go there and be a little bit like, yeah, I'll work with you guys, whatever.
All right. Well, let's
also, that's the way he thinks to negotiate. If you read his books, that's what he's like, take a very hard stance at first so that you're ridiculously over the line, and then come back to a position where you've given up some of your ridiculous position, but you've accepted a better offer than you had. That's just his strategy in doing things.
Right. Well, let's wrap it up and look at this chart, because you did bring up QE before and central bank QE policy. That's going to start to unwind. That's a couple trillion. What's a couple trillion for friends? That's going to eventually impact the market as well. Maybe not today, maybe not tomorrow.
Well, today we're down. Yeah.
Wait for the buying to come. You never know.
That's right. We haven't as we say, because we like to short the markets in the morning and they go down, and we're like, no good sell-off remains unpunished though in this market. It's like they come back so fast and so hard. You just have to short. When you get those opening pops, you short them. You take the money quick, get it off the table, wait for the next pop, short it again. It's like a little broken slot machine the way we play it.
Well, it's also like 3 o'clock in the morning, too. You could be down
Yeah.
on the overnight, 3 o'clock in the morning. I mean, it's been a relatively
It's
short
great.
bet, but we're
Well,
getting off track
both
here.
ways. Yeah, you can play it that way.
But let's talk about central bank policy and how you
The
think
central
longer
banks.
term it could impact the markets.
Well, the issue is that globally the central banks are still buying, or were buying last year, $2 trillion in assets. This year that's scaling back to $1 trillion. So they're buying half as many assets as they bought last year. That's bonds, stocks, real estate, whatever they're scooping up for various reasons. In China, it's bad debt they buy from the companies. So whatever it is in asset purchases, they made $2 trillion last year, which is effectively what QE is. Like our QE in America last year was $80 billion a month. And now they're scaling it down to 30, 40 billion a month by the end of this year, and next year it'll go down to zero. All the central banks are following a similar path. So QE is going from 2 trillion last year, 1 trillion this year. Next year, at the end of next year, zero. After that, they start selling the assets they have. So they're still buying assets. Then they're going to start in 2020. They start selling their assets, competing with you and bondholders and with the Treasury when they want to auction off things. They're going to be competing to sell bonds and notes and land and stocks and whatever they're holding on to. They have to reduce their balance sheet. All they're doing now is slowing the growth. But they're slowing the growth, and then they're going to reduce it and go the other way. There's no way that doesn't turn into like a recession or at least a flat, like depressed economy. It's very hard to do anything else.
It seems kind of counterintuitive, though, because you would think without them putting money into the markets, that would be a sign of overall health in the economy. So it's kind of counterintuitive if you look at it from that perspective. Isn't that a good sign that they're pulling out?
It's a good sign that they feel the markets can take it, and we can take it. But I'm saying it's not going to be an exciting growth. And the problem is, as I was talking about this morning, actually, I used Lowe's for an example. Lowe's is a hardware store. I don't care how big it is. They sell hardware, they sell paint, they sell lumber. It's a hardware store. It's not going to grow massively. It's already selling $90 billion, $65 billion worth of merchandise a year. Home Depot's bigger than them. They sell $90 billion. So the total hardware market, for big box is, I don't think there is anybody else that I can think of, is $170 billion, let's say. So it's like Coke and Pepsi. Maybe one will get a little bit bigger, one will get a little bit smaller, but that's the market. It's not going to change. So there's not going to be a giant resurgence in building and using tools and so on and so forth. Suddenly it's going to grow these companies. So how do they trade at 30 times multiples to earnings? Historically, these are 15 times earnings companies. They're trading at 30. They're Dow components. So you look at, and I was comparing them to other Dow components. You look at Nike, you look at McDonald's, you look at IBM. They're trading at 30 times earnings now. This is crazy.
Right.
So the market is just basically mispriced, and it's priced. And that's the point, though. It would be fine if you said, okay, they're mispriced now, but you figure like 10, 20% growth for 5 or 6 years, and they're in great shape. It's like, so even if you say you're paying a little bit too much now, you say, well, I'm paying for the future growth. But that future growth has a 2-year time limit, and not even, and then the central banks start going negative, and there's no way that people are going to start growing their businesses in that time period. So you have a year and a half, 2 years of growth left, and then it's going to flatten out for quite a while. And on that basis, you cannot possibly justify these kind of market valuations.
All right. Well, thank you very much for joining us, as always. And traders, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.